And it's not a stock, but it's a REIT, a real estate investment trust. Nexus Select Trust has listed at 103 rupees, which is just about a 3 rupee premium to the issue price of 100 rupees per unit. Now, this is India's first retail-focused REIT, and we'll have more details now. For a discussion, we have with us, I think, Dalip Sehgal, the Executive Director and CEO of the company. Dalip, thanks very much for joining in, and congratulations on going public. I see a price of almost 104 right now. So tell us, I believe you have raised a little over 3,000 crore rupees. I think 3,200. That was the size of the IPO. The rest was OFS, with some of your marquee investors selling out. What do you propose to do with the funds? Would you be acquiring more assets, retiring debt? Give us the basics.
Sure. Thank you for having me, and thank you for the good wishes and congratulations. First of all, the size is 3,200, 1,400 plus 1,800. And the issue was oversubscribed 5.75 times, so I think it's been, in a dull market, it's done well. In terms of usage of funds, the first one obviously is to pair the sponsor debt as is required by the regulations, so that's where it would be used. Going forward, any acquisitions that we need to make, there are two opportunities that we have. At the time of listing today, our LTV, loan to value ratio, is about 15.5%. Most REITs operate at 27 to 29, which means that going forward, we could take it up to 28, 29%, and that gives us a headroom of almost $500 million to acquire fresh assets. That's part one. Part two, as you're probably aware, the REIT is a wonderful vehicle for mall owners to roll in, just like Select City Walkdale is rolling in, because when you, as a mall owner, roll in, your physical asset gets converted into a financial asset, and in return, what the REIT gives you is REIT units, and there's no incidence of tax at that point in time. And finally, the returns are pretty good in the sense that it's 8.25 pre-tax is the distribution yield in year one, and post-tax is about 7.1%. And obviously, there is an opportunity for capital appreciation as well.
Any numbers then on the debt? What would it stand at post the repayment and thereafter? Do you have a long-term vision on where you'd like your debt to be?
So, like I said, most REITs operate at a loan-to-value ratio of roughly about 27 to 29%. We would operate at 15.5%, which would be about 2,600 odd crores. But going forward, like I said, there's another headroom for another 4,000 crores of debt that is possible for us to take. And in addition, like I said, we could even, if anybody wants, we could give a combination of cash plus units, or if somebody wants just units, we can do that as well.
Okay, got that. That is on the debt. Mr. Sehgal, thank you for joining us. This is Pavitra. Can you just tell us what the promoter stake will stand at after the OFS? And I think last time we spoke, you also said that you have around 10 million square feet in terms of the portfolio. What is the plan to expand this every year? How much do you think we can see in terms of an addition every year?
Sure. So I think that's a good question. If you look back over the last 6-7 years, we have added about 1.5 million square feet every year through acquisitions. That's the average. Going ahead, I think we should be able to do at least that much. Please understand 2 or 3 things. One, in India, there are only 100 A-grade assets, and out of that, the top 4 or 5 developers own 45 to 50. There's 30 million square feet, 50 odd A-grade malls out there, which are owned by people who have a single or at best 2 assets, and for them, that mall asset may not be core to the business. So very clearly, because REIT is such an efficient way for somebody to roll in, there is obviously a possibility that a fair number of them would actually roll in. What will be the exact number? Difficult to say. Where will we look for acquisitions? Clearly, first in the 14 cities where we are currently, because that would give us synergies. Secondly, look at huge consumption centers. All the state capitals, for example, are becoming huge consumption centers. We have a mall in Bhubaneswar, which is one of our best performing malls. So that would be the second level of acquisition strategy. And the final one is that we are not adverse even to going to tier 2 markets where the consumption is strong. So that really would be the way we would look at acquisitions going forward.
Okay, got that. Mr. Sehgal, so, just a sort of an umbrella question. You have, I think, 354 keys. Can you just break up the portfolio in terms of a simple percentage so we can understand this? How much is hotels, how much is retail, and how much is office? And which of these three buckets is seeing better lease rental trends? I mean, where perhaps contract renegotiations can come up, so your investors can expect higher yields and higher lease rentals. In which of the three buckets, if you could just describe that?
Yeah, so sure, for sure. I think the first thing is that we are essentially a retail company. 95% of our revenue today comes from retail. Yes, we have two hotels, a Hyatt in Chandigarh and a hotel in Bangalore, both doing extremely well because tourism is doing well. But that's not core to our strategy. Even the offices have come along with the mall. So if you take Chandigarh as a city, we've got Elante as a mall that came in. Along with it came Hyatt Hotel, and along with it came an office block, right? But we would not acquire hotels separately. We would not acquire hotel and offices separately. We are essentially looking at acquiring mall assets, and wherever it is difficult to segregate the assets, which is what happened in the case of Chandigarh, then we have no other option but to do that. So going forward, to answer your question, there is no intent to look at either offices or hotels separately. Our core focus is going to be malls going forward.
And the escalation in the rental yields, how are rentals looking? And by when?
Yes.
How long are the contracts? Are you going to be renewing contracts anytime in the near future?
Yes.
Is the market ripe for higher lease rentals, basically?
Yeah, I think that's a very good question. I think let me answer it in three parts. The first is that we are currently 96.5% leased, which means there isn't too much space now to lease. Roughly 10% of our rentals come up for releasing every year. And if you look at the past 5 years, including the 2 years of COVID, we've got an upside of about 21 to 22%. So every time we have released, and like I said, that 10% of leases come up for renewal every year, we get that 20-21% escalation. In addition to that, 95% of our leases have a contractual rent escalation of 15% every 3 years, which means every year we get roughly about 5%. And the third bit that comes in is revenue share. 87% of our leases have a revenue share clause, which means that higher of MG or revenue share, depending how well the brand has done in a particular month, we would get. Just to give you a sense, about 13% of our rentals actually come from revenue share. It used to be around 8% pre-COVID, but because of the strong growth that we've seen in FY23, almost 13% of our rentals have come from revenue share. So these, to my mind, are the three buckets from which growth in rentals will come. In terms of occupancy, like I told you, we're at 96.5. We could probably go up to 97, 97.5, but it's not wise in the mall business to be 99 or 100% leased, because then it's very difficult to move brands around when you want them to. So that's really what the status is today. In terms of overall demand and supply, let me just give you the macro numbers. Roughly, if you look at just A-grade, high-quality malls, what gets added every year is between 3 and 4 million square feet. The demand, to our mind, if you aggregate all the demand, is roughly between, I would say, 10 to 12 million square feet. So clearly today, the demand outstrips supply very, very substantially. And that's the reason why we are seeing marginal rents going up by more than 20%, not just in malls, high-quality malls, but also, as you would have noticed, in High Street as well, whether it is Brigade Road, whether it is Connaught Place, Bandra, etc. So I think it is a situation where very clearly rentals are very, very strong right now.
Mr. Sehgal, we'll have to leave the discussion here. Thank you very much for joining in, and congratulations. It's been a good listing. The stock is holding up at about 103 rupees, a little more than that, versus the issue price of 100. India's largest retail REIT coming through, Nexus Select Trust, sponsored by Blackstone. Get into a break. On the other